Hi there, and welcome to the Enlightened Super Trader Education Weekly Market Update. This is Ronaldo Soriano speaking. Okay, before I go through with the market update, just a couple of announcements. In February, we're going to have, on February 16th, the Ultimate Trader 12-part series, which is now part 2. And we're going to talk about which trading is the right vehicle for you and why it is important. And February 23, we're going to have a Forex swing trading strategy. And if you can't make it, then the next day, February 24, will be the webinar version of the workshop. Right, so what is a Forex swing trading strategy? Just a simple explanation and summary of it. Um, there's a couple of requests by some of the students to create class program where this is pretty much from 10 a.m. till around 5 p.m. in the afternoon, the whole day, and we'll be looking at module 1, the basic foundation of a swing trader, introduction to the currency markets, the difference between swing trading versus day trading, trading time frame for a swing trader, macro fundamental analysis and why this is so important, indicators that will give you confidence as part of your research for longer term. And on the swing trading methodology part of module number 2, we're going to look at the SMS pattern recognition method, defining specific entry, target points, and stop losses. Module 3 on how to set up basically a swing trading strategy, the difference between mechanical order and manual market orders, and creating your own personal checklist, trading checklist. And last, we're going to look at live cases and what to look for in terms of the trading tips with the SMS pattern recognition method. And part of the bonus of that, you get a 1 month free mentoring in a group setting environment, which we meet online for 1 hour each week. And that mentoring will be Q&A regarding the methodology and regarding your trades. So when's it gonna be? That's February 23 in Palo Alto, 2225 East Berkshire Road, and the cost for your investment is $350. And if you can't make it, basically in the office on one-on-one, then the webinar version will be pretty much the next day. All right, thank you for your time, and let's go through looking at the broader market analysis perspective of the Dow Jones Industrials 30. You can see through here in January, pretty much as per forecast, that the bulls are going to be in control. February and March, we're going to see probably a little bit more of a bears taking a little bit of control just to correct itself a little bit. However, just looking on the monthly chart though, on January, look at this. The bulls are just too strong, too powerful. The odds and probability to break to 1421, and the biggest of them all, the mother lode 14198, which was October in 2007, is highly probable. Now, obviously, the market doesn't go in a straight line, it has to create a low. But if it doesn't want to create a low, then new higher highs. Part of that. Let's go through the weekly. And on the weekly, you can see here very clearly. I know the week is not over yet. Being Monday yesterday, the bears took over. Currently, what we can see here, we have a reversal where now the body is engulfing the previous body of last week. But if it finishes like this by the end of the week, then the odds and probability that the market is going to retrace to the downside is highly probable. And where it's going to retrace down to this level of demand, which are really strong demand level at 13,600, 13,587. Right, to a smaller time frame of the daily chart. And if we can see here very clearly, these levels around the 13.6 is highly probable. Okay, the high of that, which hit exactly on the 38.2 fib. So there's a range of demand between 13,588 and 13,661, which is pretty much an 80-point difference between the demand area. All right, so currently 13,880 when it closed yesterday. 665.88, approximately about 300 points to the downside. So that's pretty good when it comes to the YMs. All right, so my take on it, shorter term, it's going to be a minor correction if it chooses to, about 13,660, 13,588. But if it doesn't want to, part of the consolidation, it's only pretty much three ways on what the market is going to do: either sideways movement to the upside or to the downside. But the cannot just go up in a straight line, has to correct itself. So depending on which one's the fake out, either the one last Friday or yesterday. So odds and probability to the downside is highly probable. All right, thank you very much for listening. Hope you enjoyed it. Take care until next time. Happy trading. See you later.